Welcome to Planet Microcap. I'm your host, Robert Kraft, and joining me today is Charles Salame. He is the CEO of Sangoma Technologies. It's a publicly traded company. I got two symbols for you: STC on the TSX and SANG on NASDAQ. And Sangoma will be presenting at our upcoming investor conference, the Planet Microcap Showcase Vegas, in partnership with Microcap Club. That's taking place April 22 through 24, 2025 at the Paris Hotel and Casino. For more information to register, to meet Charles, to see his presentation, to do a one-on-one, please register at planetmicrocapshowcase.com. With that, Charles, thank you for joining me today. How are you doing?
Not bad, Robert. How about you? Thanks for having me here today. I'm super excited to see you in Vegas, obviously, and excited to meet a bunch of your investors. Should be a really great event.
Heck yeah. No, we're very excited to have you there and looking forward to hearing the update and everything. And, it's been a few years since Sangoma was in Vegas, so this will be a lot of fun. But, we had you on back in September where we did kind of our first quick hitter here with you as leading the charge here at Sangoma. But for those that missed that interview or haven't seen a presentation from Sangoma in a while, can you give us that quick overview of the company and then we'll go from there?
Yeah, sure. So, look, I joined the company in September 2023. At the time, it was trading around 4x EBITDA. It was a company that was really a conglomerate of 11 acquisitions done over 7 years. And I had noticed that there was an incredible opportunity with all the assets that Sangoma had to be able to go after a fairly significant rising market, which is the mid-market. Mid-market is increasingly more sophisticated, primarily because of security concerns are becoming a lot more prevalent for the mid-market, as well as mainstream technology like ChatGPT has made the mid-market way more aware of technology. Therefore, this market is requiring a single vendor to provide the essential communication components that almost every business requires: voice, data, video, security, and hardware. And Sangoma had all of those assets. But back in September when I joined, they weren't quite integrated, and therefore the real value of the company was not was locked up in the fact that it was dispersed. And so over the last 14 months, since starting the company, here are just some stats for you. The company is now fully integrated. We have a brand new ERP system that really allows for a single bill of all the components. Brand new CRM system that's under Salesforce. It allows for a single quote, which is a mandatory requirement for any growing company. We've taken our debt down from 100 million to now we're 2 quarters ahead as of this fiscal quarter to 60 million. We've taken $10 million of cash out of the company, maintained EBITDA of 17 to 18%. Our free cash flow from operations has gone from $8 million to now 12 million a quarter. So the company spews out cash. All of this transformation of process systems, tools, competency, these are all the operational things that my 30 years in the industry kind of bring to a company like this, particularly in the enterprise space where I spent most of my career. And now the company is in a position where we've kind of brought debt down and cash up this year pretty significantly to in line with what we saw as favorable economic tailwinds in terms of the cost of capital coming down, which then allows us to grow the company three ways, which is the next phase of the company now that the company has been integrated: organic growth, inorganic growth, and geographic and global expansion, which we're undertaking as we speak.
Very good. All right. So you pretty much hit on my next question a little bit there, but maybe maybe there's some more things we can also cover from the Q2 report. Like I said, we did this first interview back in September 2024. The company just put out your second quarter fiscal 2025 results on February 6th. You kind of went through some of the actual highlights, but then you also talked about some of the revised guidance for fiscal 2025. So can you just give us any highlights that we missed? Some of the revised guidance for fiscal 2025, and also maybe some of the reasons for the performance that the company had.
Yeah, so as I said earlier, the company had 11 different acquisitions that we have now integrated into a solidified core company. And over the course of the last 14 months that I've been here, we had to do all the non-sexy work of putting the company together, building processes, systems, structure, the right management team, competencies, improving the balance sheets, increasing cash flow, and all of those elements have been done. During that period, we also developed what was core to the company. So this company was sort of labeled as a UCaaS company. It is actually not. It's a pure technology SaaS company that provides essential voice, data, video, security, and hardware components for small and medium-sized businesses. Now, during this period of transformation, one of the assets that was in the portfolio was hardware resale. And this business really just sells other people's technology. It's fairly low margin business, but it's very transactional in nature. Whereas the SaaS business, the core of the company, is more long-term annuity revenue, 3-year contracts on average, 80 to 85% gross margins, whereas the hardware resale kind of operates at 10 to 12% gross margins. So our initial hypothesis at the beginning of the year was, I have this asset of hardware resale. Let's use that to drive up the top line revenue. There is some margin coming out of it while we're building the underlying premise and adding to our bookings and larger transactions of more higher margin recurring revenue. And around November, to make a long story short, after the elections, when Donald Trump came in, we had won a very significant federal government contract. That contract basically allowed us to be able to sell to the federal government. Once the Trump announcement was made, we began to see in November and December that obviously the government was going to go through some very significant changes. And the risk for us as a public company is to try and give guidance on, first of all, transactional hardware business, which was one of the elements we were focused on, and then to do it in a federal government environment where there was clearly some uncertainty, especially after when the executive orders came out, and some of our orders that had been promised to us had actually not been awarded to anyone, completely shut it down. So I decided at that point, given our debt was down so far, to take the SG&A I was going to put into the lower margin hardware resale business while I was growing the underlying recurring business and move that SG&A over to our recurring high margin growth business, and therefore revise our guidance accordingly. Now, if you look at the way I revised guidance, I took down revenue by almost $15 million of hardware resale, but my margin, EBITDA margin, only dropped by about $1 million. So it kind of gives you a sense that that was pretty low calorie revenue anyways. Most of our investors thought it was the right move. And we're in fact now going to be accelerating the divestiture and acquisition part of our business because the underlying core of the company has now been integrated where I can bring in inorganic growth along with organic growth at the same time, 2 quarters faster than I anticipated. So we have an extraordinarily optimistic outlook for the remainder of this year and certainly going into FY26 with an accelerated inorganic strategy, an accelerated organic strategy focused on high margin, high recurring revenue. And we're going to be jettisoning some of these business units that are very, very low margin and not core to the company, which in fact will position the company from a 70% gross profit company to an 85% gross profit company going into our fiscal 26 year, because we're going to be getting rid of some of the low margin hardware resale, non-recurring revenue business that doesn't fit our recurring revenue model.
Absolutely. So, my final question then for you here today, you kind of went through what folks should, some of the value catalysts and stuff for 2025. What would you say then to close this out, in your opinion, what would you say is that one thing or one or two things that folks who are following the Sangoma story or maybe new to the story should really follow as things progress here in 2025?
Look, Sangoma is one of these really unique, I called it a diamond in the rough. It's one of these really unique companies that has all the essential communications of voice, data, video, security, and hardware. And I would challenge your investors to do 2 things if you're following Sangoma. One, try and find another company that has the entire integrated bundle of voice, data, video, and security and hardware, all proprietary, all owned by us, all very high margin, all recurring. There is no other company that does that today in the small tech world. And the second thing to follow is we're a $240 million, $250 million company. We got $42 million of EBITDA, generating 17, 18% EBITDA value, free cash flow of almost 44 million, 45 million per year post payment of the debt. And we're trading at around 6 times EBITDA multiples. If you look at any of our peer groups that only have one of the components, usually just UCaaS or just voice, they're trading at anywhere from 14 to 19x EBITDA. So we are, for the kind of value that is in this company, the cash flow, the current debt position, I think we're executing on our strategy to produce a recurring revenue model to support both the small and mid-market, which is now the emerging growth area of the business. We have all the essential ingredients now fully integrated, and we're trading at very low multiples. So lots of value in the company going forward. And I think this is a real opportunity to jump into the company. And I would tell you, if you're following us, follow our portfolio, our valuations, and I think follow our balance sheets. If you compare our EBITDA or our balance sheets against any competitor in the market, and that's not being boastful, it's actual fact. Very, very strong financial company with an integrated backbone, a strong management team going into a market that has, one of the fastest growing markets, which is the mid-market, with a set of assets that no one else has. Is now our opportunity to be able to grow that business organically and inorganically that should be of interest to all your investors.
Absolutely. Well, Charles, with that, where can our audience go and find more information on Sangoma?
Certainly go to Sangoma or investorrelations.com. You can contact me directly at csalame@sangoma.com, and I'll point you in the right direction. And look, I look forward to seeing all of you out there in Las Vegas, the Paris. Track me down, and I'll definitely spend some time with you, take you through more details on the company. And
Awesome. Well, Charles, thank you so much for joining me today. Again, that's sangoma.com for more information. Really appreciate you taking the time. Good luck, stay safe, and I'll see you in Vegas.
all right, pal, take care. We'll see you in Vegas.
Thank
Bye
you.
now.